how do Vanguard's funds incorporate changes in market composition stemming from things like buybacks, share issuance, IPOs, whatever else happens, like employee stock compensation, all that kind of stuff?
So every index provider is slightly different, but for the most part, they're trying to make those changes as soon as they occur. So for a secondary offering, if it's greater than 5%, it's happening that day's close of business, which is great for us because, like I said earlier, we have the opportunity to participate in that secondary, buy directly from the company, typically
Mm.
at a discount from the previous night, but we're also not having any impact on the security by purchasing it since we're buying it from the company. IPOs, depending on the index provider, I think Russell might be the longest at their quarterly rebalance. Crisp, if it's fast tracked and meets certain criteria, it's going to be at it within 5 days.
Hmm.
But ultimately, that's another one of the value add strategies that I talked about earlier. We're going to participate in most IPOs for the portfolios and hold that IPO until it's included into the benchmark. We tend to see outperformance from holding those IPOs as a whole. And again, it's a liquidity opportunity for us to get into that security without any impact into the name. Buybacks, they'll tend to be on quarterly rebalances. And then depending on the different index provider, that could be an annual reconstitution with Russell. It could be a quarterly with Crisp. One of the things that's unique about Crisp is that they actually take their rebalance and they spread it over 5 days.
Mm.
That way we're able to minimize the amount of trading that we're doing on any given day to try to lessen the amount of impact that we're having on any security.
Hmm. On IPOs, you're participating in the IPO or buying it on the secondary market?
We participate in the IPO in the primary market.
Wow. Okay.
We typically would not participate in the secondary market after they start trading until they're added to the benchmark.
Okay. And is that like which IPOs do you participate in? How does that happen?
We evaluate all of them depending on the name and the size and its likelihood of being included will determine whether or not we participate in that IPO. We're not necessarily making a call to say this is a great company or not. We're saying this IPO based on these characteristics will be added to this benchmark. We will need to buy this security in 5 days from now. This is a liquidity opportunity, and historically IPOs have actually held the IPO price up into inclusion time.
Did not realize that. That seems like a great thing for index fund investors. Is it? I'm assuming it is much better than buying in the secondary market, at least.
Yeah, to give you kind of perspective, even in the secondary markets where we're participating and buying directly from the company at a discount, we see that strategy on average adding about 1 to 2 basis points a year of performance back to the portfolio. And we see that, obviously every year is different depending on the market, but that's something that we typically do that adds value year over year to the funds. And add a little bit back of the expense ratio to some of these products.
Yeah, that's incredible. We had Gerard O'Reilly from Dimensional on fairly recently talking about a whole bunch of the stuff that they do on implementation. One of the things he talked about that was interesting that I hadn't really realized was what they do around cash mergers, where they'll take special precautions around not adding further positions to a cash merger because that stock starts to behave like cash. Does Vanguard think about that kind of thing?
Yeah, absolutely. We look at every single change, whether it's cash and stock, especially in the corporate action space, and try to figure out what is best to do as far as holding, selling, or trading that stock. Where the biggest opportunities come into play are a lot of the complex corporate actions, cash and stock, ones where you're electing. That's where we try to evaluate very closely which is better, cash, which is cash and stock, all stock, and we're trying to anticipate what that exchange ratio would be to try to add a little bit of value in the portfolios. But we've been very successful in that space as well.
It's crazy how much thought goes into this stuff that I really don't think most investors in Vanguard's products realize. So on Marco's paper, they basically show, or they suggest that index funds are bad market timers, is kind of what they call it, because of the way that they respond to changes in market composition. And they suggest in the paper that it could come with pretty meaningful costs. I think they estimated around 60 basis points annualized, and they show that if you delay incorporating changes in market composition by up to 2 years, you can eliminate a lot of that cost. So I thought that paper was fascinating. How does Vanguard incorporate that kind of research, or consider that kind of research into the portfolio management process for index funds?
I did a couple days ago talk to Marco about it, and I'll offer 3 points. I don't. Hopefully Marco listens. I don't think he'll disagree with what I'll say here. Number one, I would say, to be clear, the paper is about index construction methodology, not index funds themselves. Marco does a great job in there of saying they use index funds because the index funds themselves do a fantastic job of being the real life version of this on paper index. I think the second thing that's important is when we have these like wonky discussions about indexes and construction and moving parts is, okay, the window of when new issues are implemented, it's one of those real life decisions that has to be handled. And when we think about Marco's work and saying, well, maybe if you delayed the window, the fund could realize better performance. That then gets us into this existential question of, but that would mean the index fund is taking on more active risk because the index methodology, as is right now, is this window. Because I could even make this theoretical case, well, why isn't even 5 days? If this idea of an index fund should reflect the investable opportunity set, then in theory, there's no reason the minute a stock goes new issue, that's the market, it should be included by the index provider right now today. And then the third thing that I mentioned to Marco, and I just thought about this for a little bit, was, we've all contemplated this idea that insiders know best. And I don't mean nefarious dealings. I just mean you're a corporate CFO or a treasurer, and you decide to issue new stock, or you decide to buy back stock. Chances are you want to issue new stock because you think your stock is overvalued. You have information that the rest of the market doesn't. If you're buying your shares back, maybe you probably think the shares are undervalued. And so what I mentioned to Marco is to see that finding that this for index funds, because they're reflecting the index's methodology, to recognize or realize a negative abnormal return of what they buy versus what they sell, kind of makes sense that a company would issue new shares that are overvalued, and therefore when they're issued, those who consume and buy realize a negative abnormal return. And I'm not saying that explains the entire effect, but it kind of jumped out as me. That result kind of makes sense when we think about it that way.
Yeah, and I think a lot of paper talked about turnover and excess turnover. And if you look at broad market index funds, the turnover is really low. So you're talking maybe 5% a year or so, maybe a little bit higher than that. But if you think about that type of turnover, even if the underperformance was there, it's not that significant. And I think from a practitioner perspective, I would say, wow, if we had a rebalance that was 2 years out, that could be a very, very sizable rebalance. Are you just trading then impact costs for these other costs, and how does that play out in the market? So that's how I would think about that. I mean, if you go styles, so if you go growth or value, where you tend to have the highest amount of turnover, sometimes 54%, I would tell you that you're in that portfolio because you already are making an active bet, and you want your portfolio to reflect that active bet as soon as possible, as opposed to having a jumbled portfolio of growth and value securities. But I would say watch your turnover in your funds. I think it does matter. Reduces transaction costs, taxes, and impact.
What do you think some of the practical trade-offs would be if you did decide to reduce the rebalancing frequently in order to, address some of these concerns that Marco raises in his papers? Is it something that practically can be done? Does it reduce costs? Does it, I mean,
One, at least initially, we wouldn't necessarily be able to participate in the secondary offerings, which we have shown historically has added value to the benchmark and also reduced transaction costs. So I think that would be initially the first. And I think it would make our rebalances when they happen significantly bigger, which, it depends. Does liquidity show up? It shows up today on our rebalances, so it would probably show up in the future. But I think that would be the unknown for me, and then not being able to participate in IPOs, in the public offering, cash tenders. I'd have to see how it would ultimately work, but I think it would make things a lot more challenging. And in fact, what we've actually seen from index providers is actually going the other direction. I think Russell just announced that at least for their styles, they're going to a semi-annual rebalance from an annual rebalance. So their best thinking is get the index as close to the market as soon as possible.
All right, I don't want to act like I'm trying to squeeze more out of Vanguard because you guys have already done so much for investors. But other than fee reductions, which you guys have obviously been so incredible with, and I mean, like revolutionized the investment industry with, but they don't have much further to go. And Andy, you've mentioned a whole bunch of items, but I still want to ask the question, how can Vanguard continue to increase the value it adds, other than fee reductions, which are basically zero now? How can Vanguard continue to increase the value it adds for index fund investors?
One of the ways we do that today is through our securities lending program. So we have, a global team of security lending folks in the U.S., London, and Australia that are out loaning our securities. And they add a significant amount of value back to the fund. I think we're unique in that we don't have any split, like Vanguard doesn't take a share of that. It covers the cost of that program. But after that, 100% of the revenue is put back into the portfolios. So I do think that makes a significant difference, and we kind of take pride on ourselves if we can add back the expense ratio of these products via the value add strategies plus securities lending. That means a lot to us as fund managers. Again, some of the other ways we're doing that is through advocacy. We touched a little bit on working with exchanges in other countries to try to make them more efficient, more transparent, more fair. We're always trying to access different markets to get price transparency. So I think it's just being a good global citizen of all investors at the end of the day.
If your listeners might have some interest in sort of the quantification of what Andy talked about with securities lending, on the Vanguard corporate website, where we have a lot of our thought leadership published, you can search for Understanding Securities Lending in 3 charts. And it does a great description of showing, number one, just like what's the amount of basis points of value added back for large, mid, and small cap funds, both Vanguard and then the industry ex Vanguard. And then the second chart is showing a little bit of differences, or the outcome of the differences of lending philosophy. Vanguard tends to be what's called a value lender. We have a tendency to lend out less. We focus on stocks that are more difficult to borrow. And the charts then show, best way to describe it would be, given the dollar is out on loan, how much are the funds earning? And Vanguard funds are earning percentage points of return. And again, for listeners who think, oh my gosh, Vanguard's taking a lot of risk. No, that's not the total amount. It's the given you put $1 out because of we're lending securities that are difficult to borrow. It's a huge value program. And then the third chart series is what Andy talked about is, hey, okay, given the funds earn, large caps are like low single-digit basis points, mid caps are mid to high level single-digit basis points, and small caps might approach double digits. You think to yourself, okay, how much of the expense ratio of the fund can be offset? And you get a really good sense of, if X percent is the expense ratio, Vanguard funds making up half that difference, 40%. I don't remember the numbers exactly, but again, understanding securities lending in 3 charts based upon what Andy talked about, just some really cool visuals to get a sense of what is that value, Ben, that you're talking about with index funds. What are other ways value can be realized?
We'll dig that chart up and put it in the YouTube video too.
It strikes me you could take all of these value add strategies that you've discussed and employ them all. It seems to me that on some level, if you are tracking an index and low tracking error is a number one priority, you're a little bit constrained in what you can do with those value added strategies. And I wonder, it would be fun to think about, creating a total market fund. I wouldn't go so far as to call it full-blown active where the portfolio manager had discretion to pick stocks. They would need to hold the universe of stocks, but they could have a little bit more freedom at the margins, and it wouldn't necessarily be the goal. Like, for example, if you had 8-10 basis points of tracking error in 1 quarter or 1 year even, that would be tolerable as long as the expectation was you would be able to use those strategies to outperform VTI over some longer period of time. I don't know if that's just describing an active fund, but I'm seeing it as more only slightly active and much more towards the passive end of the continuum.
I think what you've just described was my minor tirade earlier on about its characteristics, not labels. But I think that perfectly describes what I was trying to talk about is I'm not sure why we necessarily constrain ourselves into this binary world of active or passive. What you've just described is its characteristics and objectives, and there's probably a market out there for investors who would be looking for the exact strategy as you described it.
DFA does have a fund called DFUS, which is their U.S. total market ETF. It's kind of like that. Do you think Vanguard would ever consider doing a non-indexed total market fund that, like Dan said, really gets to leverage all the value-added stuff that you guys are already doing?
We can take it back. I mean, look, we're always interested in what products, when we think about new products, like what products have enduring investment merit. Obviously, we're going to put a lot of consideration into what risk premium could be harnessed. Does it offer diversification? Can it be implemented at low cost? And obviously, we have an enormous active fund franchise here at Vanguard. And I'm not going to say, no, we'd never consider it, because if the characteristics are there, absolutely, we'd consider it.
We want 1 basis point, by the way, if you use the idea.
I think it's such an interesting idea just because, in the case of Dimensional, they're doing lots of cool stuff on implementation too, but most of their funds, other than that one U.S. market ETF, obviously have the factor tilts. And there are lots of investors that I think want great implementation without being constrained by an index, but don't necessarily want the tracking error that comes with factor tilts. Yep. All right. Second to last question for you guys. What is, Dan, you want to take it?
Nope. It's all yours.
What's the biggest concern? We've talked about a lot of the value-added stuff that Vanguard's doing. What's the biggest concern that each of you have about index fund implementation and trading?
Okay, you handled the trading. I'll try and give it.
Yeah, sure. For me, it's things that are outside of my control that go wrong, especially on rebalance days. It just tends to be a very large amount of trading for us. And so maybe from a systems perspective, a couple years ago, we had an exchange that went out for a period of time during one of the rebalances. We're very conservative with our orders, especially around those days. So we got them out even that day well before the outage. But I think it's things like that occur that are somewhat outside of your control, outside the norm, that cause a lot of commotion and potential issues that just keep me up at night. Again, we're big, a lot of trading goes on, and it's really around those rebalance days that keep me up at night.
I would just want to comment on the idea of the products then being used by investors. I think Jason Zweig had an article in the Wall Street Journal the other day, and basically what it's speaking to is just because something's labeled an index fund doesn't make it safe. It doesn't automatically make something a panacea and nothing can go wrong. For investors who are building portfolios, you still have the responsibility of the good old basics of asset allocation and diversification and risk. And whether it's an index fund or an active fund, that's just a piece. that goes into something bigger. And with that portfolio construction, again, focusing on characteristics and not labels, there's a lot of responsibility in do that. So the tools are means to an end.